I study a fundamental finance class lectured by Professor Joshua from MIT, and today I want to summarize a very important subject is portfolio management. This video I will mostly focusing on some of the basic definition in the subject of portfolio management. So portfolio management is a process of making investment decisions to achieve specific financial goals, balancing trade-off between risk and return. So we will approach this topic with a blend of theory and practical insight and giving you tools to analyze and build effective portfolio. Let's break down the key principles and framework that define the modern portfolio management. One, what is a portfolio? So it is simply a collection of assets which can include stock, bonds, real estate, commodities, and even cryptocurrency. The goal of portfolio management is to construct and manage the collection in a way that maximizes return while minimizing risk, in line with an investor financial goal, risk tolerance, and investment horizons. Number two is the risk and return. It's the foundation of portfolio theory. So portfolio management is all about balancing risk and return, right? There are two key dimensions that define performance of any portfolio. First is return. This is gain or loss from an investment, often measured in a percentage of the original investment. It includes capital gains, the increase in the price of assets, and income like interest. Second part is risk. So in finance, risk refers to the uncertainty of return and the possibility of losing money. It often measured by the volatility of return. Higher risk generally offer potential for higher return, but it also means greater chance of losses. So the key metric here is expected return. Like, is it the average return you expect from asset or portfolio? Second is standard deviation or volatility. It is a measure of how much return fluctuates around the mean. The third part is risk adjusted return. It measures how much return you are getting for the level of risk taken. So one key principle in portfolio management is to maximize return for a given level of risk, or conversely to minimize risk for a given level of expected return. But in the modern portfolio theory, or MPT, the modern portfolio theory is developed by Harry Markowitz in the 1950s. It provides a mathematical framework for constructing an optimal portfolio. The theory is based on a few key ideas. First is diversification. Spreading investment across a variety of assets reduces risk without necessarily sacrificing return. The rationale is that when some assets underperform, others may outperform, reducing the overall impact of poor performance. Next is efficient frontier. In MPT, the efficient frontier represents the set of portfolios that offer the highest expected return for a given level of risk. Portfolios that lie below this frontier are considered suboptimal because they do not provide enough return for the risk taken. Graphically, the efficient frontier looks like an upward curving line. Moving up the curve increase expected return but also increase risk. Next is optimal portfolio. The optimal portfolio one is positioned on the efficient frontier, and it will differ depending on an investor risk tolerance. A more conservative investor might choose a portfolio lower on the curve, less risk, lower return, while an aggressive investor might aim for more higher risk, higher return type of portfolio. There are also mean variance optimization. MPT uses a mathematical process called the mean variance optimization, used to identify the optimal portfolio. This involves calculating the expected return, standardizing deviation, the risk, and correlation between return of different assets. Next is correlation and diversification. Correlation is a key to understanding diversification in portfolio management. Correlation is a definition to measure how two assets move in a relation to each other. Positive correlation is the asset that move in the same direction. For example, if one goes up, the other goes up soon. While the negative correlation, the asset move in the opposite direction. Like if one goes up, the other goes down. Ideally, a well-diversified portfolio contains assets that are not perfectly correlated with each other. This is because assets don't move in the same direction, reduce overall risk. The benefit of diversification increases when assets have low or negative correlation. Next is the capital asset pricing model, or CCPM. The CCPM is a fundamental tool used in portfolio management to assess the risk and return of individual assets. It explains the relationship between systematic risk of an asset and its expected return. CCPM is based on the idea that investors need to be compensated in two ways. Number one is time values of money. The investor expects risk-free rate of return, often measured by the yields on government bonds. Second is risk premium. Investors they always expect compensation for taking additional risk. This premium is proportional to the asset beta. The measure of its risk relative to the overall market. So we have the formula here, where ERI equals to RF plus BI multiplied by ERM minus RF, where ERR is expected return of the assets. RF is risk-free rate. BR is the beta of assets. Is sensitivity to the market risk. ERM is the expected return of the market. Well, in simple terms, CCPM help you assess whether an asset is offering enough return for its level of risk and whether it should be included in a portfolio. So 6 is another definition. The efficient market hypothesis, EMH. So the EMH is the theory that asserts that financial markets are efficient in processing information. This means that asset price reflects all available information at any given time. It's impossible to consistently beat the market by identifying undervalued assets. So the implication of portfolio management is that if markets are truly efficient, then trying to pick stock or time the market becomes futile. Instead, passive investing strategy like investing index fund may be optimal, since it's difficult to outperform the market through active management. The 7th definition of this subject is asset allocation. So asset allocation is one of the most important decisions in the portfolio management career. So it refers to how you divide your investment across different asset classes such as equality like stock. It represents the ownership of the company. They tend to offer higher return but come with higher risk. Second is fixed income of bonds or debt security that provide regular interest payment and tend to be less risky than stock. Cash and cash equivalent. These are the low risk assets that provide liquidity but offer lower return. And the final is an alternative investment include real estate, commodities, hedge fund, and private equity. These may provide diversification benefit but often come with higher risk and complexity. So the right asset allocation depends on risk tolerance. Is how much risk the investor can handle. Second is investment horizon. Is a time frame over which they plan to invest. Longer horizon generally tolerate more risks. And goals is a specific financial objective like retirement, education, or buying a house. Next we go to strategic versus tactical asset allocation. So strategic asset allocation is a long-term set and forget approach where investors establish the target asset mix based on their risk tolerance, investment goal, and market outlook. Periodically, the portfolio is rebalanced to maintain desired mix. And tactical asset allocation is a more active approach where the portfolio manager takes a short-term adjustment to the asset allocation based on the market condition or the economic forecast. The goal is to take advantage of market opportunity, but it also involves higher risk and complexity. So the next definition we're gonna learn is rebalancing. Like over time, the value of asset in a portfolio change as the market condition fluctuate. Rebalancing is the process of realigning the portfolio to its target allocation. For example, if stock outperform bonds and take up a larger percentage of the portfolio, rebalancing could involve selling more sub-stock and buying bonds to restore the original asset mix. Rebalance is super crucial for maintaining the risk profile of the portfolio. Without it, the portfolio might drift into a riskier allocation than intended. We have the final subject of today, the risk management strategy, the most important lesson in managing portfolio. So a few key risk management strategies include diversification, reducing risk by investing in variety of assets that behave differently in various market conditions. Hedging is using derivatives like option or future to protect against downside risk. For example, a portfolio manager might buy put option to protect against a decline in stock prices. Credit value at risk or VAR. This is a statistical method used to estimate the potential loss in a portfolio over a specific time frame. Given normal market conditions, it helps manager assess the maximum loss that could occur at a given confidence level. Like it is about 95%. And the final thing is stop loss order. It is the action of setting automatic sell orders for assets when they reach a certain price to limit potential loss. So in conclusion, like portfolio management is both an art and a science. The science like in the models and tools like MTP, CCPM, and some statistical analysis. The outcome from tailoring these tools to unique goals, preference, and risk tolerance for each investor. Well, successful portfolio management involves not just maximizing return, but also managing risk, diversifying assets, and continuously optimizing based on changing market conditions and personal goals. To be honest, the whole course of MIT Professor Jack Xian is super cool. And as a finance VTuber, I realize I have much to learn and I want to share with you guys what I learned in recent time. Because if you are an investor, you are investing into the market, or you are just a trader trading on this market, you're gonna need some fundamental knowledge of how the market works and what is the fundamental of finance, the fundamental of market, the fundamental of society, or even how the supply chain works. So that's what I want to share with you guys in this video. So if you find this video helpful, please leave a like and subscribe to my channel. See you in the next video. Bye.